All right. So we're done with the dense economic analysis stuff, and now it's time for something more interesting, which is real estate. We're going to do a quick 2023 flashback, and then we'll get to the business of forecasting single family and multifamily performance in 2024. So I'm going to start this journey with single family prices. I always like to look at single family first because single families are a much larger market than multifamily. And single family prices affect multifamily prices, affect multifamily rents more than anything else. And I'm going to start by saying the following words. The biggest disruptive trend you will take away from this presentation is single family prices are in a bubble. But this is one resilient bubble. All predictions that single family prices will decline in 2023 turned out to be wrong. Last year, I showed you a chart of 21 different analysts, with CoStar being the most bearish at negative 20%, and the Brokers Association, the NAR, National Association of Realtors, being the most bullish at 2 or 3%. Usually the NAR is wrong most of the time. In this case, they were right because home prices did not go down. Home prices went up, right? They went up a couple percent. So not a huge number, but they went up a couple percent. Now, so why do I consider single family to be in a bubble if it's only going up by 2%? Well, for that, you only have to look at the three numbers on the right? I want to ask you to look at this number. Mortgage payments since COVID, since Q1 2022, have now gone up 111%. That's a shocking number. I want to point out that salaries in the US have gone up by 19.7%. 111% increase in your mortgage, 19.7% increase in your salaries. Now, of that 111%, roughly 38% came because prices went up, right? Prices have been going up since COVID every single year. The rest of it came because interest rates roughly doubled. Well, if all of this stuff happens, you tell me, with these three numbers completely out of whack with salaries, why shouldn't home prices go down? Well, because it's a bubble and it's a resilient bubble, right? And I know that there's a lot of single family fanboys in this audience that are typing right now. They're thinking, Neal, you're wrong because interest rates are going to go down. They're going to be much lower in 2024. So home prices really aren't a bubble. Okay, fine. Let's look at those mortgage rate predictions for 2024. Here they are. These don't look low to me. Even if we pick the most bullish projection on this page, that's the green one from the Mortgage Bankers Association, they think rates are going to be 6.1%. Why? Because rates are predictive. They've already gone down quite a bit. So they can't really go down unless the Fed cuts aggressively. So we're at 6.7 now. They think it's going to be at 6.1. Well, they're predictive. I don't see them going down much. So I think these numbers are right. So bottom line is these are very, very high interest rates. Wouldn't that make the bubble burst? No, it won't. Because despite those astonishingly high interest rates, almost nobody in the marketplace that we can find is predicting a decline in home prices this year. Even the two red bars on the page from Realtor and Zillow on the left barely move the needle, right? One of them is minus 0.2, minus 0.1.7. That's not really a decline. I mean, it's just rounding errors. Why? Because everyone's pointing out that there's low unemployment, there's high wage growth, and more than 9 million jobs are open in the US. So no one's predicting that the housing bubble is going to burst this year. And all of them are pointing out that this is because of a unique factor called the lock-in effect. So let's study the lock-in effect. Let's say you're a homeowner, right? So you purchased your home 5 or 6 years ago. It's been appreciating every single year. And right now it's worth about $1.2 million. That's my example. This California example, right? And you have about $350,000 of equity, home equity that you've built into your house. So a couple of years ago, 2021, you refinanced, you got a great rate, 3%. And that's going to put your monthly mortgage payment right around $3,600 principal and interest. And then you find out your wife is pregnant and you're going to need an extra bedroom. So today in 2024, you go check out properties, you see homes with that extra bedroom are now going to be 1.5 million, right? And you crunch the numbers and you have about 350K in equity that you can take from the sale of your current property and apply it towards the down payment. So that's awesome. But with rates around 6.6%, here's what you realize. Even with $350,000 down through that equity buildup, your new multi-payment is $4,000 a month higher at $7,600. That's nuts. Who can afford that? And this is the reason why we are seeing a massive number of homeowners, tens of millions of them, having to stay put, stay on the sidelines, because payments just don't make sense anymore. And that lock in effect means that the housing bubble is unlikely to burst and maybe not even deflate for a number of years. There's very little inventory in the marketplace. And that ridiculously small amount of inventory is leading to a new phenomenon. This is known as forever renters. And this is our second disruptive trend, forever renters. Now, it used to be that 2/3 of Americans lived in their own home and about 1/3 lived in a rental property of some sort. But with these astonishingly high prices, astonishingly high mortgage rates, and that lock in effect, we are now seeing middle class Americans become forever renters, an entire generation, right? You can see from this graph that buyers today, and you see the big spike here, this is COVID, right? So see this massive spike here in the last 3 years. Buyers must now earn $115,000 a year to afford a typical home in the US. And that typical buyer doesn't make $150,000. They make 75K in 2022. So let's call it $80,000 today. So that's a $35,000 gap that's almost impossible to bridge today or even in the near term, not even in the next 5 years. And remember that 115K number that I just gave you, that's for the whole US, right? Let's look at some of the cities that have high job prospects where people have lots of jobs, expensive jobs, and see what the numbers are like there. In San Francisco, you need a median income of $404,000 to afford a home. And even though San Francisco prices have gone down this year, the doubling of mortgage rates meant that this 404,000 number that you see here, it is up by $100,000 in a single year. And in case you're thinking, Neal, why would I go live in San Francisco? I can go to Phoenix. Well, is Phoenix cheap anymore? Is Phoenix cheap? It's $121,000. And markets around the US that were considered cheap before COVID are also around or over 100,000. Dallas, 116K. Miami, 145K. Nashville, 124K, right? Austin, 125K. In fact, the only large metros that are near $100,000 now are Houston at 92,000, Atlanta at 107. That's it, just two. And that is what is driving people to third tier cities. So we are now seeing an amazing phenomenon where people are moving from Nashville to Knoxville, Chattanooga, Memphis. People are moving from Phoenix, not just to Tucson, but they're moving from Tucson to Flagstaff. As technology allows smaller and smaller metros to take a bigger and bigger portion of the job, this migration to smaller cities will continue to accelerate because these numbers are just absolutely freaking insane. People not only are forever renters, well, to be forever renters, to actually be able to afford some of their rent, potentially, they need to move to smaller metros. Or if they want to buy a starter home, they need to move to a smaller metro. And I'm not talking about second tier metros that people have moved to in the last 10 years. I'm not talking about third tier metros. And here's an example of how these phenomenon, the forever renter phenomenon, the third tier metro phenomenon, is changing the winners and losers in the United States, right? So the biggest winners since COVID hit in terms of states, you'd think would be, Arizona, Florida, Texas, the cheap markets. Well, would it shock you to learn that Texas is no longer in the top 10 since COVID, right? Because Texas markets are not cheap. 115K for Dallas, Houston at 92, Austin at 126. Texas is no longer ultra hot for home price growth, though it remains a top market in the nation for people to move to. We are seeing new winners. States that you see on the screen like Montana, Idaho, North Carolina, Tennessee. These are the states we're watching when we're looking at creating profits for our investors. So that, in a nutshell, was our roundup of the single family market in the United States and all the disruptive trends that are changing the way we do single family in the US. Now, time for a quick look at multifamily, because a bunch of you guys are multifamily people. Let's take a look at what's happening in the multifamily marketplace. And the multifamily market is in an incredibly balanced place. Now, I generally don't say anything like that for the multifamily market. I tend to consider it expensive, but I want to show you some fantastically interesting numbers. Most people at conferences, they stand up and they say multifamily is still too expensive. And they're probably right. But do you know what a renter cares about? They care about rents. And here, the multifamily market has shown an astonishing sense of balance. Now, I want you to look at these top two numbers on the top right in green. Now, rents have increased 19.6% since COVID. In the last year, it was about 1%. So they were going up like crazy, and then now they slowed, right? 19.6% since COVID. Now, how much have wages in the United States increased by? 19.7%. So you notice that rents are actually going up at the exact same pace as wages, the exact same. There is no better example of the balance in the multifamily market than those two numbers. Since COVID, multifamily rents have only increased by $385. 385. You see that number here, right? Now, mortgages have increased by a stunning $1,140. That's 3 times as high as rents. Don't believe me? Move your eyes here. Watch this. 1023, 2162. The difference, $1,140. More than double. That's where we are. So the fact that the multifamily market is not doing what the crazy crap that's happening in the single family market is the good news. There's balance. Rents are increasing exactly at the same speed as wages. But that's where the good news ends, because there's a ton of bad news. And that is massive incoming supply and over 3,000 properties in distress in the multifamily market. Let's dig into those. First, the incoming supply of new apartments. I mean, it's stunningly high. Not since this dude was president of the US in the 70s has America seen this many apartments coming online as we're going to see in 2024. RealPage predicts that there are going to be 672,000 apartments delivered in 2024. That is an absolutely crazy number. And it's definitely more than we can absorb in a single year. Now, it's super important to understand that the vast majority of the supply is in Sunbelt markets, Austin and Raleigh and Nashville and Jacksonville and Charlotte. Those are the markets that are likely to be more impacted in 2024, not the entire national market. Now, some of you may be wondering, or you've said it on social media and you think it's the truth. Neal, there's a slowdown in the single family construction market, and that's going to help us with absorption for multifamily. Yeah. Nobody's building single family anymore. It's too expensive, Neal. We need more apartments. Short answer is you're wrong. This is what's happening in the single family market. A bunch of analysts made predictions a year ago, a year and a half ago, that we might see stunning drops in single family new construction. None of it has happened. The large builders, they have not seen significant declines in their pricing, though they're heavily using incentives to push their sales. So they're basically shrinking their profit margins using incentives, but they're keeping the prices about the same. And as you can see from this graph, they're currently scheduled to build almost 1 million homes, 976K this year. So we're not seeing a very significant decline in new construction on the single family side. So that's really unlikely to help multifamily this year. And this new supply that I just mentioned, it's not spread around the US smoothly, right? So you've got the Sun Belt that's in this yellow color here, right? It's got a very significant amount of new inventory coming in. So 3% of its total existing inventory is coming in a single year. And it's projected that Sun Belt markets will see negative or flat rent growth. You see that right here, right? Now, you can clearly see the Northwest, which is in green, has only 1.3% inventory. So because of that, its rent growth should be pretty strong at 2.6%. The same thing applies for the Midwest. Low inventory coming in, rent growth about the same. So these are the two areas that will do really, really well. The West is a weird market, right? It's the only market where rent growth is expected to be negative, even though the inventory coming in is low. Why? The West is suffering a great deal from interest rates because they have the highest prices in the country. And the higher the prices, the more sensitive you are to interest rates. So that level of sensitivity is very high. And that's why we're seeing rent growth be a challenge. All right. So now let's look at some rent growth projections for all you multifamily guys out there from 3 different high quality sources. Yardi Matrix, well, they're fairly bearish. They think that rent growth for 2024 is going to be under 1% here in blue, right? So 1.6 for 2023, okay, not good growth, not bad growth. Um, but here in 2024, they think that we're going to be at 0.8 because they think that the incoming supply is going to take the entire year to get absorbed before we start seeing 3 to 4% rent growth in 2025. So that's Yardi Matrix. CoStar, on the other hand, is more bullish in that they think that the slow period of rent growth, the sub 1% rent growth, is only going to happen in the first quarter of this year. And then they see a sharp acceleration in rent growth, which you can see in these areas. So low rent growth in Q1, low rent growth in Q2, and then a sharp acceleration Q3, Q4. And obviously, I'm hoping that CoStar is right and Yardi Matrix is wrong. The third source is Marker. And they're even more aggressive in that they're projecting rent growth for the entire year will be 3.9%. Now, for those of you that don't know what this 3.9% means, we'll all be delighted if Marker was right and 3.9% was the number at the end of the year. I tend to have more faith in Yardi Matrix and CoStar, but it's nice to see that someone's predicting rent growth in this year in the 4% range. Freddie Mac, second largest lender in the US, expects that we are going to see good income growth in certain interesting markets. I've shown you this graph before in prior years, and it's never had Oklahoma City or anything in Oklahoma in there. You notice number one is Oklahoma City, number three is Tulsa. And then on the right side, you see the cities with all the big construction pipelines in Nashville, Austin, DC, New York. They will all have higher vacancy and almost no rent growth at all. All right. So that's where we stand with rent growth in the US. So now let's finish the multifamily section with the keyword, one of the big trends, and that is distress, right? So this is the sword that's looming all over our heads, right? Yes, there is distress in multifamily, but let's try and understand this distress instead of just throwing it around. So many of you may have read clickbait articles on the web about $1 trillion in multifamily debt needing to mature. Ooh, scary, right? What most people don't tell you is that this $1 trillion number, which is on the screen, is by 2028. Interest rates are expected to come down this year, expected to come down next year. So if someone's looking to refinance in 27, 26, or 28, it's less of an issue, much less of an issue than it is this year. And by the way, this $1 trillion number offers zero indication of the percentage of these assets that actually might face any level of distress or any level of discomfort whenever they refinance. So this is just the base number, $1 trillion. But people are using it to scare you, so you click on articles. Now, when I appear on podcasts, I do some mental math there, and I think that I mentioned, I think the total amount of distress is about $90 billion, give or take a bit, in multifamily. Now, here's data. I recently found this from Bloomberg, right? Which mentions on the right about $67 billion of multifamily assets that are potentially troubled. Potentially, right? That's the potential, not necessarily troubled today, right? Now, keep in mind, this is a very small portion of the overall multifamily market because the overall multifamily market is $4 trillion. 67 billion is about 1.5% of the multifamily market that could be in distress. Now, on the left, you see it's not just apartments, right? There's all kinds of commercial real estate, challenges, distress, that is possible. Now, it's very important to distinguish the black bars, like this one, from the blue bars, right? Because the black bars are showing the assets currently in distress, like 34.5 billion in office. And the blue bars are showing assets that could be in distress in the future, depending upon how interest rates go, right? And you notice industrial, because of the Amazon effect, shows almost no assets in distress, but a significant number that could be in distress. In fact, notice that the apartment bar at 8.4 billion is 1/4 of this bar. This is the real distress. This is the area that people are really worried about because this 50 billion could potentially go upwards if more people don't come back to the office in the coming 2 years. So with apartments, There's a lot of potential for distress, $67 billion, but real distress is only about $8 billion. I know that sounds like a big number. I just want to point out to you that $80 billion, which is 10 times this $8 billion number, is 1% of multifamily. Sorry, $40 billion is 1% of multifamily. So this number of 8 billion is 0.2% of the entire multifamily market. It's very important to keep perspective when you're looking at these big numbers because they always look very, very big. Now, even amongst multifamily syndicators, there is this irrational, somewhat nonsensical belief that there's already a large amount of multifamily distress. And this is just BS. Okay. Here you can see the actual delinquency rate by loan category as of Q3 last year. So this is the end of Q3. So only about 4 months ago, right? As you can see, the big bars in terms of delinquency are credit cards, auto loans, then home equity loans, then delinquency in single family homes, and so on and so forth, right? And then eventually you get to offices and things like that. Where is multifamily? Well, it's all the way in the bottom, this bar in green. So once again, as of Q3 last year, only about 0.4% of all multifamily assets in the United States were delinquent. 0.4%. Will it increase? Sure. I think it's going to probably go all the way up to 1%, 1.5% before it starts to decline again. But will it increase anywhere near the levels that you see at the top of this chart? Heck no. There's actually no conceivable scenario that logically could be presented where that actually happens. And let's say it happens. Let's say it happens. It's still going to be restricted to certain markets, right? So this green bar here shows them that most markets in the US really don't have much distress exposure, right? Some of the peaks that you see here are Washington, D.C., that's D.C. here, and that's San Francisco. So overall, the markets that are the most exposed, right? So you see these big bars here are basically New York, Dallas, Atlanta, LA, Austin, and San Francisco, which has the highest exposure. I wanted to give you two different sources because there's a lot of argument about this. So here's Bloomberg, right? Their list of cities is slightly different. So once again, they've got New York in there. They still have Los Angeles in there. But now they have Chicago, Dallas, Houston in the top 5 list. Once again, I want you to look at something. Look at the screen. These are some blockbuster mega cities. And even in the biggest city in America, more than 10 million people, the total number of potentially distressed assets, not distressed, but potentially distressed assets, this bar here is about 450 buildings. Do you know how many tens of thousands of buildings New York has for apartments? It's a massive number. This is what I keep saying. These numbers are big. Investors are going to lose money. There's going to be pain. All of that is true. But equating that with distress in the market to the level where prices could crash, there's no mathematical evidence of this. I just keep seeing it on social media, and these days people think social media is actually the truth. So I think this is a good summary. I like this guy's summary. His name's Spencer Gray, founder of Gray Capital. And he says, while the next 6 to 12 months are still uncertain, fair, I can imagine a scenario where we witness some real distress all at once, probably in some markets, which will create a lot of fear. And that may create a window where some incredible assets can be acquired at a significant discount from previous market pricing. Any distress will be short, agree, with the interest rates gradually lowering and the base case for multifamily being as strong as ever. So far, by the way, some of the stuff that he talks about, incredible discounts, hasn't happened in any market in the United States. Might happen in some. So here's my summary. Investors are scared because of what happened in the last 24 months. They're making the exact same mistake that they've already made in 2008. They're doing this exact same thing. I'm not seeing any difference in people's behavior. What I'm seeing today are multifamily assets that are at least 20%. So the multifamily market has now declined 20%, right? That's the new number from all the analysts. Some areas have declined 25, 30. So everything is discounted. 20%, 25, 30%. And all of this is not happening in a weak economy. It's happening in a strong economy. It's happening in an economy where single family is clearly in a bubble. And it's also happening in a market where more and more people are assuming loans. So they're not basically taking on new expensive loans, they're assuming loans that were locked in 2022, 2021, and because they're assuming, they're getting the discount, the 20+% discounts, but they're not having to pay the high interest rates or deal with exposure to interest rates going back up again. It's a tremendous time to be buying multifamily. And the people in the know, they understand this. Take a look at Sharpe ratios. If you don't get Sharpe ratios, you can ignore this slide. That's the Sharpe ratio for multifamily. And on the right side, large cap stocks, corporate bonds, government bonds, small cap stocks, commodities, even commodities, right? So you when you're looking at the Sharpe ratio, it still remains the darling of real estate. Now, I don't want to say that this is a low risk investment. Multifamily has always been a significant risk investment, and I don't want to downplay that. But the key that you should understand is that this remains the darling child of institutional investors and the darling child of real estate. All right, time to finish off with the city by city shootout. I know lots of you are here just for that, so let's get started. But before we show you the top cities of this year, let's spend 60 seconds on what Pro Capitis is doing. We are eating our own dog food. We're currently in contract on this property, Midtown Ridge, 193 units in Chattanooga, Tennessee. Value add property, proven upside, terrific high growth market. We love that we can get huge discounts on properties like Midtown, even though we're able to assume a fixed rate loan that's significantly lower than the market rates today. So we get all the benefits of the distress in the discounts, and we don't have to deal with the downside of floating rates or high fixed rates. And we're buying this property at about 37% below our peak offers in 2022. So terrific property. 193 units, was built in 1986, so good bones. Spread across 9 acres, 93% occupancy, and strong effective rents at $1,248. We've actually raised about, Anna, is it fair to say we've raised about 80% of the money for this property already?
A little over than 80%,
Okay.
Neal. So we're well on our way, yes.
We're in the 80s, right? And what's more important to point out is that even if a property appraises for 1 or 2 millions more than when the property goes into contract, whatever the purchase price is, people are really happy about that. This property appraised for $7 million more than the purchase price 5 months ago. $7 million more. The appraisal was 36.6 million, and that was after all of the rate hikes were done, right? So after that appraisal was post every single rate hike, right? And it was appraised at 36.6 million. We're buying it at 29.6. Discounts are a wonderful thing. That's what it looks like. Very nice, good shape, good bones. And we are projecting that investors investing 125 grand are going to come in at a 20% annualized return and a 2x equity multiple on this. For those of you that this is not your cup of tea, I would love for you to ask me about Mission 10K. It is our mission to build 10,000 townhomes. Think of it as my personal life mission, and it's an incredible mission. There's massive value. Build to rent is unquestionably going to be one of the biggest trends in real estate for the next 10 years. Why? Because those 20 million families that I mentioned that are between that 75K in income, the 115, they don't want to live in an apartment. They have good incomes. Before COVID, these people would be buying their own homes. Today, they don't have a chance of doing that. They want to live in something like a home. And that something like a home is a rental new construction townhome. So that's our mission, to build 10,000 of those. We need your help. We need your assistance. We need your oomph on Mission 10K. So ask us more about that, and we'll be telling you more about it in coming months. Time to finish up with the shootout. I like to start with U-Haul. Texas and Florida retain their number 1, number 2 ranks for the states with the highest number of people moving. Number 3, number 4 were also similar compared to last year. So North Carolina moves up a spot, South Carolina moves down a spot, Tennessee moves up a bit, Idaho moves down a bit. New entry on the chart, so Washington State moving up from 23rd to 7th. But otherwise, Arizona, Colorado are right about where they were a year ago. Biggest losers are the same, Massachusetts and California. Notice that California has been the biggest loser 4 years in a row. Now, keep in mind, Texas is number 1, but its price growth for single family is now outside the top 10 because it's becoming a more expensive state. All right, done with states. Let's move on to top cities. Never in my life did I think I would see a city in Ohio at the top of the top 10 housing market lists. And never in
Wow.
my market, yeah, never in my life did I think I'd see a list that didn't have a single city in the Southwest, right? This is Realtor.com's top 10 housing markets for 2024, completely skipped the Southwest. So you've got, Midwest, Northeast, some of the cheaper cities in the West like Bakersfield. The trend is clear. The top boom towns for the moment are not doing well because of high interest rates. Now I want to balance out that realtor.com list that was a little hard with this second list from Zillow, a little more balanced. But once again, the state of Ohio rules. Number two, number three, number eight are the top three
Wow.
cities in Ohio, right? So you got Cincinnati, Columbus, and Cleveland. Amazing, right? Zillow has sort of a more balanced approach. So you do see some boom towns in the list. So you see Atlanta, which was our city of the year last year, Charlotte, which was our city of the year in 2020, Orlando, and also Tampa, which was our up and coming city in 2022. So all of the cities that we've been talking about in the last 3 years are here. It's also nice to see Indianapolis in the list because that was our
Yep.
up and coming city 2 years ago. Um, Another list. This is from Realtor magazine. Sorry, this is from Spinks. So they are giving the nod to some interesting future boomtowns. I want you to pay attention to number two, Grand
Yes.
Rapids, Michigan. Also pay attention to Myrtle Beach, which is interesting that it's becoming more of a boomtown in South Carolina. So there's some very interesting stuff here. Pittsburgh, which is a perennial non-performer, is finally beginning to live up to its potential. Also, a city that I think is going to do really well is Knoxville, Tennessee. This is a very interesting list. I really enjoyed this list. Marker is basically trying to figure out what city is likely to become the next Austin, right? In their mind, it's Raleigh, Durham, North Carolina. We picked it as joint city of the year in 2020. Provo, Utah, we picked it in 2016 and 2017 twice. There are only two cities that we picked twice. Madison, Wisconsin, a nice up and coming city. Kansas City, it's great to see that. We picked it as an up and coming city all the way back in 2019. And then we have Colorado Springs. So not sure about Colorado Springs just yet. We want to see more of it. But the other four are very interesting cities. If you're interested in, figuring out what cities is going to be the next Austin, it's probably going to be one of those top four.